I think that the most important thing that people have to get over is that they are going to predict where the market is going to go better than everybody else over time. You got to get over that. I know it sounds weird. How am I going to make money if I don't predict where the market's going to go? But you got to get over that. I've never seen it work. Positioning is the best place. Talk is one thing. Positioning is much more valuable. It's one thing to say you're bullish. It's another thing to be, mega levered in. No matter what it is, you should always wait for the market to confirm what you're thinking before you do it. I always say it should be obvious. If you have to ask yourself, gee, was that like one of these news failure events? Then it probably wasn't. Just take your loss. You know what I mean? It's like, and a lot of times you'll take your loss and then the market will go back to the way you wanted it to go. You have to stay alive long enough to get lucky.
All right, welcome back, everybody. It's my pleasure to introduce our next speaker, Jason Shapiro. Jason is a hedge fund manager with over 3 decades of experience in the markets, and he was featured in Jack Schwager's latest book, Unknown Market Wizards, and will be presenting today on his trading methodology using COT data. Jason, welcome. Great to have you as a part of the conference. Like I said before, I think you add a valuable and very different perspective, but a very valuable one nonetheless. So thank you so much for your time and for being a part of this.
No, thanks for having me.
Yeah, of course. Let's go ahead and dive right in. You prepared an excellent presentation, and then we'll have a Q&A afterwards. But for everybody watching, if you do have questions, please leave them as we go. And with that, Jason, I'll kind of hand it over to you.
Okay, thanks. So, I think when it comes to trying to make money over time, trading the markets, which is obviously what we're trying to do here. Um, in my view, people focus, I think, on the wrong thing. And this is going to sound a little silly, but people spend a lot of time trying to focus on predicting whether a market is going to go up or down. Um, and clearly, you need to do something to try to make money, but I don't think that that is the game here. I think that game gets you in a lot of trouble. To me, I believe the game is trying to focus on finding trades or situations where your potential return is much higher than your potential loss. So really, we want to find situations that are give you a risk reward in your favor, where if you're going to make on it, it's going to make you, let's say, $5. Whereas if you're going to lose, you're going to lose $1. And this way you can be right less than 50% of the time and still put up very good returns. Um, so I think that is the game. And the problem is that people are focusing a lot on that other game. They're using charts or they're using whatever to try and make this prediction of whether a market's going up or down. And I truly believe that is the wrong game, right? And that is why people struggle. To try and predict the future on a consistent basis is a very, very, very difficult thing to do, right? Um, so if we are going to try and focus on rather than predicting the future, but instead trying to figure out where potential risk reward can be in our favor, right? Um, how do we do that, right? And to me, what drives the markets is the fact, first of all, that the market is a discounting mechanism, all right? Which implies that all known information is already in the price. Okay. So unless you have some sort of inside information, which is not known, it's very difficult to build an edge trying to predict, right? And clearly, if you have inside information, that's not a very good thing for you to trade off of anyway, because you might find yourself in jail. And that's probably not where you want to be, right? I always say a big part of this game is staying alive long enough to get lucky. Well, if you're in jail, you're going to have a hard time making money in the market. So we're going to throw out inside information here, and we'll just assume that the majority of the time, all known information is in the price of the market. And that's because there are so many people doing this, right? You're not going to come up with something, right, that the millions of people in the market have not already thought of or come up with or discounted in, right? To tell me whatever the employment report is going to be this or that, the other thing, how are you going to come up with a better forecast than the thousands of people that are trying to forecast this, right? You might once, but I mean, you're flipping a coin, right? Over time, which is the key to this game, you're probably not going to be able to do that. So how do we then find um, these risk reward opportunities? And the way that I try and do it is I'm looking for um, within this discounting method mechanism where things can be over discounted, right? And how do we find that? And the answer to me is in a combination of positioning um, and and sentiment, right? These things swing way too far a lot of times because of the fact that people are looking at the same information and coming up with the same conclusions, right? So if they all come up with the same conclusion because it's obvious, like some macro view, right? Then they're all going to put that trade on, right? And it's going to be over positioned, and therefore the risk reward at that point skews, right? I often make the comparison to betting on, let's say, a football game, right? Um, if we have two teams playing, and let's, for argument's sake, say the best team is playing the worst team, coming up with the conclusion that the best team is going to win, right, does not give you any kind of edge in betting on that game, right? In fact, it has nothing to do with it because there's a point spread, right? The point spread is the discounting mechanism, right? So the question is not who's going to win. The question is, are they going to beat the point spread or not, right? Um, so in that light, how do we know if the point spread is too high, right? Um, and again, I go into positioning. Um, so just as a couple examples to make it super simple, we all remember the GameStop situation, and it came up again a few weeks ago, but when it really happened that first time, did GameStop go up because the company got better? Did GameStop go up because their revenues were getting better? Did GameStop for any of those reasons? It didn't. The company had nothing to do with it. This was a perfect example of 100% positioning. Everybody knew, all these smart hedge fund managers and all that dug into the balance sheet and did their research, knew that GameStop company was getting worse and worse by the day. And so they got short, right? As you would. And they ended up getting mega short, right? I believe that there were more shorts out there than there somehow were shares even available, right? And that was sniffed out by the market and they squeezed them. And GameStop went up however many times. I don't remember what it was, 20, 40, 50 times it went up, right? And it had zero to do with any kind of fundamental. This was complete. I think we can agree. This was completely a positioning thing, right? Um, so I think that's a good example of that. And if you look, GameStop then went right back down over time. It took a little time, but over the next year, year and a half, 2 years, it went pretty much right back down, right? Because there was no change. This is all just a squeeze of shorts, right? And another favorite example of mine where this proved to be true was the long-term capital situation in the late 90s. Long-term capital, for those who don't know, was probably the biggest hedge fund at the time. These were the geniuses of Wall Street running this thing. And they found a trade, which was in Europe. The euro was coming into existence, hadn't come into existence yet, but there was a date for when it was going to come into existence. And the math was pretty simple. If the euro came into existence, then interest rates across Europe, um, all interest rates across Europe were going to have to converge just by math. If they're all under the same currency, then their interest rates have to converge. But before the euro came out, that was not the case. You had Italian interest rates at whatever, 9%, and Spanish interest rates at 3%. So you could sell those Italian interest rates at 9%, buy the Spanish interest rates at 3%, and when they converged, you could make a lot of money. Provided that the euro was going to come into existence, that mathematically had to happen. Okay. So if you could do it for $1, I think these guys figured you could do it for $100 or $1,000 or $1 million, right? They all levered up. This was long-term capital levered up. And then there was a bunch of groups within the banks. Long-term capital were the guys that came out of Solomon Brothers, and then they were replaced by other people that were doing the same things. And all these groups levered up massively because they had a mathematically guaranteed trade. And what happened along the way? There was another trade they had on that was like this Russian arb trade that blew up, right? Because they were doing this Russian trade with the ruble and the forwards, and it was all written with Russian banks, and the Russian banks were out of business. So they missed out on the idea that there was risk there, right? Counterparty risk. So there was nothing they could do about it. They had to just sell things to cover their margin on that trade. So what are they going to sell? Well, they had to sell out of some of this highly levered um, European interest rate convergence trade that they had on. But what they found when they went to sell it was that there was no one to buy it because they were levered so much, and so many of them were levered so much, there was no one to take the other side. I know they went to Soros and tried to get him to buy it. I don't know if it's true, but the rumor was that Soros took a look at it and he actually shorted the thing because he knew these guys were screwed, right? They went to Buffett, I don't think Buffett bought it, there was no one to take the other side. So they got killed. Not only did they get killed, LTCM went out of business and Solomon Brothers went out of business. Solomon Brothers was the biggest thing in the world back then. They completely went out of business on this trade. And you know what? In the end, the European interest rates did, in fact, converge. The euro did come into existence. And if you had held these trades, you did make all that money that you had planned to make. So again, there was no fundamental change whatsoever, right? This strictly blew these people out because of positioning. The positioning was way too much. They got nailed for some other outside reason that they didn't see coming, and there was no one to take the other side. Purely positioning. Okay. So now that's another one of my favorite examples of that. So do they all work out like this? Clearly not. But I think the idea of what I'm trying to say becomes clear. So how do I look at positioning? Well, I'm a futures trader. I look at positioning in the futures market. This is the commitment to traders data, which is released every Friday. Okay. And it's as of the Wednesday close. So it's as of the Tuesday close. So it's 3 days delayed, which is not that much when you are, I'm not day trading this stuff. I'm looking for major turns in the market. Um, so there's three types of traders. When you fill out a futures account opening form, you have to declare yourself. You are either a speculator, which is most of us, or you are a commercial, which means you're a farmer, that's hedging his weed exposure or whatever. And the advantage of saying that you are a commercial trader is that you get much lower margins because they know you have the physical to back it up, right? So the risk to the counterparties is less. So it gets broken down into these commercial traders, what they're doing, and then what the speculators are doing. And the speculators are broken into two groups, right? Large speculators and small speculators. And that's determined by if you have a certain position size in your account for each market, there's a different level. But if you're over X amount of contracts, you have to declare that, right? And so if you have to declare that, you're considered a large speculator. And everybody else, me, you, whoever, falls into the small speculator category. All right. So this data is all giving out. Where are the commercial traders positioned? Where are the speculators positioned? Um, and this is what the chart looks like of it. The red being the commercial speculators, I mean the commercials, and the blue being the large speculators, and the yellow being the small speculators, right? So there's a lot of ways to use this data. I personally like to use it. I pick turns in the market. I'm picking sort of medium to long-term turns in the market. And the way I'm doing that is I'm looking for speculators to be mega one-sided, as we've talked about, right? So they're over discounting in either the trend, which a lot of futures traders are trend followers, or they're over discounting in the fundamental that they're seeing to make them so short or so long a certain market. And once it gets to that crowded level, I'm looking to go the other way because it gives the potential, if they're mega, mega short, that if the market turns, right, they can all get squeezed and there can be a big move the other way. And if the market doesn't turn and the fundamentals continue to be, let's say they're all short, the fundamentals continue to be poor and the trend continues to be down or whatever, the move is not going to be as big as the other way. which is where I get into that risk reward thing. Because they're already in. You know what I mean? All this stuff is already very much discounted in, right? Doesn't mean it can't happen. It happens. I have trades that go against me all the time, but they're very small relative to the moves that go the other way. So I think that that's the key to it. So that's the data that I use a lot. On top of that, I'm also looking, reading, listening to what a lot of these strategists are talking about, right? Because that also helps to determine if it's being discounted. And positioning is the best place. Talk is the one thing. Positioning is much more valuable. It's one thing to say you're bullish. It's another thing to be, mega levered in, right? And this is trying to capture that. But I do listen and read and to try and figure out why it is that they have this big positioning, what the fundamental story is. Because what I'm looking for at that point to trigger a trade, I don't just get into a trade because it's crowded. Um, I'm looking to trigger a trade where these people get what they were looking for. So they're short the stock market because they think that inflation is going to be too high, right? So now I'm looking for them to be confirmed on that. Okay, here's an inflation number, and it's much higher than expected. And then the market doesn't go down on that. That's when I trigger a trade. And why didn't it go down on that? Did everybody not see that the number was higher than expected? Of course, everybody saw it. My answer is because everybody's already short, right? So therefore, it can't go down. The market's not going down anymore. They're already short. It's already over discounted, right? So that's how I use the data. But it can be used for a lot of other things too. Let's say you're a trend follower and you're following a trend. You'd much rather be in a trend that is not crowded than a trend that is crowded. You know, I think that we could argue that if two markets charts look exactly the same, and one everybody in the world is long and one nobody's long, you would want to be in the one that nobody's long rather than the one that everyone in the world is long, knowing that everyone in the world doesn't become a profitable trader. In fact, the vast majority of people lose money trading. So you want to kind of be against that, right? That's another way to use it, but there's a tons of ways to use this data, which I'll get into a little bit later. But so I'll give a few examples from recently. This is the copper chart. And we know that if you pay attention to copper at all, that in the beginning to the middle of May of this year, people started to get super crazy with copper, right? It became the new AI play. All of a sudden, we kept hearing about how they were going to have so much more electricity to support all this AI stuff and copper was needed for all this electricity and all that. People started getting sort of crazy bullish there. And this showed up in this positioning chart. You can see, look where the commercials were, super short, and look where all the speculators were, super long, right? So at that point, we're looking to get short. And then again, we're looking for some kind of news failure type event to confirm it. Just like any kind of trading you do, no matter what it is, you should always wait for the market to confirm what you're thinking before you do it, right? Rather than fighting the tape just because you think you know what's going to happen, right? That'll get you run over, right? So you get a confirmation and we get short copper. And to this point, not every one of these trades works, I promise you, but to this point, this trade has done well from here where they were max crowded to where we are now. Copper's down a good 15%, which is a pretty good move in a month. You think about if the S&P moved 15% in a month, people would be going crazy. Um, and there it was, we had this news failure here and then it kind of came down 15%. And I'm still riding this trade. And what I do because of what I'm trying to capture, which is this overcrowdedness, once that goes back to neutral, I get out. I either get stopped. If I am to short something and it goes back through new highs, well, then I get stopped, right? If I'm trying to pick a turn and I'm short and it's at a new high, then clearly I didn't pick the turn. So by definition, I didn't get it, so I'm out. But for my winning trades, I wait for this stuff to go back to neutral because then my edge is gone. My trading, both my entry, my stop, and my exit, it's all based on the edge I'm trying to capture, right? So if the edge is everybody's too crowded, when they are no longer too crowded, I get out, take my profit, right? That's what I capture, right? Or that's what I try to capture. And we're waiting now on the copper to get less crowded here and get out. Don't know how long it takes. Sometimes it takes a few weeks. Sometimes it takes a few months. I've had trades last over a year, which is rare. Usually it's 3 to 4 months kind of area. Um, Here's another example. This is a current example, the Canadian dollar. We currently have speculators the shortest they have ever been in the Canadian dollar in history. Okay. Um, does that mean the Canadian dollar is going to go the other way? No. What it means is that if the Canadian dollar starts to go the other way, there's potential for a huge squeeze, right? And on top of that, I have noticed, probably not coincidentally, in the last 2, 3 weeks, a whole bunch of these macro gurus are coming out and talking about the Canadian economy and how weak it is and how they're going to have to keep cutting rates and all this. So we know that that is very much discounted into the market, both from what these people are talking about and from the fact that the positioning is showing that, right? So again, I wait for, let's say, if that's why they're doing it, I wait for a weak number in Canada, which should mean rates are going to go down in Canada, which should mean the Canadian dollar goes down. And the Canadian dollar doesn't go down on that. It probably goes down when the number comes out and then it rebounds and finishes up. Reversal day. So I will buy the Canadian dollar then. I will stop on that low of that day where they freaked out on the bad news, or I will ride it until this goes neutral. So that's a trade that's going on right now on the Canadian dollar. Uh, and this gets to like this idea, which is how I see the market cycle, right? Again, being a discounting mechanism based on positioning and based on sentiment. At the market highs, everyone sees it, right? It's everything is bullish. There's no reason to not be long at a high, right? And then it comes down and everyone says, oh, well, we're just consolidating here. And then it comes down a little more. Trend followers start getting stopped out of their longs, right? It's usually where I start getting out. This is where positioning will start adjusting and trend followers will stop getting stopped. And that's where I get my profit, right? And then suddenly it keeps going down more. Now the trend followers are getting short. And now the fundamentals, lo and behold, are becoming bearish, right? You're starting to see some bearish things. And then at the very bottom, of course, trend followers are maximum short. Fundamental guys are maximum short because it's obvious how bearish everything is. And then the whole thing flips, right? And that's because, again, of the discounting mechanism, right? Um, Another example of a recent trade, this was cotton, okay? People had gotten super bullish cotton here, super long cotton here. A piece of positive news came out when the WASDE report was released, which gives your cotton supply demand. It was bullish. It ran up, you see, closed down on the day for no reason, right? You can see the spike here where it spiked up on the day and then closed down. And so we short it there. We get stopped here and we ride it until this stuff goes neutral. And when it went neutral, it was about here, and we get out. And look, it was a good trade. I was risking $1, um, and made six. If I could keep making 6 to 1 on these trades, right, I can theoretically be right 1 in 6 times and be flat, right? And I tend to be right about somewhere around 35 to 40% of the time. These end up working like this. So that's adds up over time, right? So that was another example of a recent trade. Um, this was the best trade that I ever had doing this stuff, um, which was a Swiss franc in 2015. You can see that these people were massively short the Swiss franc here. Um, we had a reversal day on a Friday. I got long, and we woke up on Sunday night, and there was some intervention. The Swiss bank had come out and said they were going to depeg the Swiss from the euro. Okay. And the Swiss went up some ridiculous amount, right? Um, but the interesting thing for me with this was if you look at it, this is not like years, this is months. A few months later, the Swiss was right back to where it was. And you can see how quickly all this positioning changed, right? These guys are super short. They were all forced out, obviously, with that kind of move, right? All the trend followers had to get out. A lot of people blew out on this trade. There was a number of people that were in the press having blown out on this trade. So they all got out. And what happened? The Swiss went right back to where it came from. So again, the fundamental story really had nothing to do with this, right? But the positioning story is what made this thing go up so much, right? Because if you look at the fundamental story, it just went right back to where it came from anyway, right? But again, people were way too short. Some exogenous event happened and they got squeezed and they got crushed, right? And I am really just trying to catch the opposite side of those trades. Okay. It only takes about three, four, five trades a year like this to make, well, like this, forget about like this, any of these, three, four, five trades a year to make my entire year. Um, and it's all because of this mass positioning, right? So I just like to show that one, A, because best trade I've had in probably 10 years, and B, because it just kind of shows that the fundamental story really ended up being nothing, right? It was all a positioning thing. So that's that. So, we talk about other ways to use CFT. You might say, look, Jason, I don't trade futures. So what do I care about this stuff, right? But the truth is, it can help. If you see, for example, hey, people are mega short stock indices, right? You may not trade stock indices, but I bet you trade Qs or you trade spiders or you trade some of that. It's the same thing, right? Or you might trade individual stocks. Well, clearly the chances of your individual stock going up is higher if there's a good chance that the market is going to go up, right? So you may look at this and be like, hey, they're super short the stock market. I want to be long this stock. That can help build confidence in putting that on, right? You can also see things like sectors, right? So let's say, okay, they're super short the stock market and they're also super short oil. Okay, well, maybe that might be a good chance, A, to get long a stock and B, to get long an oil stock, right? Can help you determine that as well. And of course, there's ways to trade this stuff without futures anyway. Like I say, you can trade the Qs, you can trade the spiders, you can trade even the commodities and the currencies have ETFs. Everything's got an ETF nowadays, right? But so you can trade it like that. But you can also look, a lot of your stuff you probably know is correlated to various things. This might be correlated to the dollar. Well, you're seeing COT stuff on the dollar. That might be something, right? Like now we're seeing COT stuff on the Canadian dollar. That implies that there could be a big move up in the Canadian dollar. Well, you maybe trade things that are correlated to that Canadian dollar. Or you might be in things that are going to benefit from the Canadian dollar going down, and maybe this would be a good hedge for you, right? Okay, well, I can get long Canadian dollar, or I can get long the Canadian dollar ETF just to hedge this position because I know that this position is correlated to the Canadian dollar going down, right? Might be a good way to look at it too. So there's a lot of ways to use this stuff. Like I say, I use it a certain way, but there's so many ways that you can use this, and it's all based on this whole idea of over positioning, right? Um, so that's kind of really how I approach stuff. And I think, again, I will say that I think it's super important to understand the concept of um, the market being discounting and the positioning being what discounts. A lot of people will argue that price is the discounting mechanism. And I argue that that is not the best way to look at the discounting mechanism. I argue that positioning is the best way to look at that. It's not, hey, the price of this thing has gone up a lot, therefore everything must be discounted in, right? You look at obviously what everybody looks at now, Nvidia. People thought that that was the case at 400 in Nvidia, or 500, or 700, or 900, and as it turned out, the thing went to 1200, right? So if you were trying to guess where price was discounting that in, you were getting run over, right? I think that it's not this has gone up a lot, therefore it's discounted in. It's everybody is long this thing already, therefore it's discounted in. That's how I try to look at it, right? Um, and this all comes down to sort of a way to be contrarian, right? And being contrarian price is to me, believe me, I've tried it, okay, um, is what gets you run over, right? That's called fighting the tape, right? And fighting the tape over time tends to be a pretty bad idea, right? Um, so it's not price that you want to be contrarian. It's mass participation that you want to be contrarian over time. That's what's going to work for you. So that's how I do it. People ask for books and references and all that. I always think that the Market Wizards book, I understand that I was in the last Market Wizards book. That's not my point here. I think the first Market Wizards book and the second Market Wizards book and the hedge fund Market Wizards book tell you 99% of what you need to know about how to make money over time if you are open to what they are saying. I learned from these books. I read that first Market Wizards book the first day I put on my first trade when I was 22 years old. I went to the store. It was actually in bookstores then. It wasn't the thing that it is now because it was a new book. It just looked kind of cool to me. Interviews with top traders. I was like, that makes sense. Why not try to learn from people that have been successful? And I read it that night. And I probably read that book 50 times in my life, at least. I think those are very valuable books for this stuff. And I only put another book on here, Why You Win or Lose, because I happened to find that a little while ago. You could read that book inside of an hour, hour and a half. It wasn't even written by a market guy. It was written by this guy, Fred Kelly, who was just an observer in the 20s of the markets. He was a writer. The market, obviously, in the late 20s was a very popular thing. So he got into the middle of it and wrote about what he observed. And I think it's great. It's a super easy read. And I think that he went in there unbiased, right? And came out the other end with this is what I observed actually worked for people, right? Um, I think that's a great book too. And of course, on our webpage, we have a ton of members and they have all added books that they thought were valuable. You can go there and look at, there's dozens and dozens of books, but these personally are my favorites. Um, then we were asked, who are some of our favorite traders? But for me, what I like to look at is some of my favorite faders. We have a saying, don't trade, fade, which means don't think, don't think you're going to put together this macro analysis or this fundamental analysis that's going to be better than everybody else and you're going to make money do that. I would rather find the losing traders, of which there are many out there in the public, and try to fade them, right? Let's go opposite them. I'm just looking to make money. I'm not trying to be a hero. I'm not trying to be the smartest guy in the world. I'm not trying to prove to everybody that I'm right all the time, right? I just want to make money, right? And what I have found is, again, this goes into the whole positioning thing. When so many people on TV, on Twitter, on everything are saying the same thing again and again every day, that starts to indicate that that's where consensus is. And you want to start to look to go against consensus, right? And again, not until the market confirms it. I wouldn't do anything unless the market confirms first, but it starts to prick the idea of, hey, there's mass consensus here. A, should I be in these trades if there's mass consensus here? Maybe I should get out or maybe I should reduce, right? But B, once the market starts to confirm, maybe I can go the other way and make money. You have to remember, over 95% of people lose money doing this. So why not make it easy and just go opposite those 95% and make money, right? Doesn't make you a genius, doesn't make you a hero, but it makes you money, which is what we're trying to do, right? So clearly, listening to people laugh at me all the time because I watch these market channels and people are like, oh man, the people on there are so stupid, why do you listen to that? And I'm like, that's precisely why I listen to it, because I'm looking to fade them. So rather than favorite traders, I like to think of it as favorite faders. And I'm not going to get into individual names. There's plenty of people on there that you can find. If you watch that, you will see have a history of being wrong all the time. There's plenty of people with social media. I'm not here to bash anybody individually, but there's plenty of people that are on social media that many people know and have observed as being wrong all the time. And it's funny because, like I'll be in my car and I'll be listening to, let's say, Fast Money on CNBC, and I'll have somebody in my car that has nothing to do with markets. They don't trade markets. They're not involved in markets. And I will, of course, be ranting, and I'll be like, this person has no idea what they're talking about. And the person next to me will look at me and be like, it sounds to me like they know what they're talking about, you know? And that's the thing, right? It's not that they don't know what they're talking about on a sort of first level thing. People will sit here and make the argument that the Canadian economy is super weak and they'll give perfect examples and it all makes perfect sense, right? But that's not what works because, like I say, there's no edge there, right? If they all know it, then where's the edge, right? Um, so when I say they don't know what they're talking about, it's not that they don't know what they're talking about on this level one thing. They don't know what they're talking about from a point of view of, hey, if I can see this and everybody else is seeing this, then isn't that already discounted in the market, right? They don't like to look at it like that for whatever reason. They should, because this discounting process is page one of any kind of book about finance, right? But they don't like that. They like to be right. They want to get on TV and show they were right. Oh, see, I told you the Canadian economy was weak, right? It's like, okay, you did tell me that, but the Canadian dollar's gone up 10% since you said that. It's like, they're like, oh, I hear it all the time from these people where they're like, oh, I got what I was talking about. I got totally right. The market, I didn't get the market right, but I got that other part right. It's like, that's great, but that doesn't make you money. We're not trading contracts on the GDP of Canada. We're trading the Canadian dollar. You have to get the market right. And so they look past this point, and I get it. They're being paid to be on TV and give these sort of macro views, but um, those will kill you, in particular when everybody's agreeing with it. Okay. So that's my thoughts, really. That's what I have to say. I hope that helps people. I hope that it's clear. And certainly any questions, I'm more than happy to get into.
Okay, welcome back, everybody. Just wanted to make a quick announcement about something, a project that we're super excited about. We'll be hosting a TraderLion webinar featuring Jason Shapiro, of course, talking about how to interpret and trade based on COT data and positioning. We're excited about this. You can visit traderlion.com/university to register. Spots are limited to 500 live participants. And Jason, just want to kind of hand it over to you. What are you most looking forward to sharing with the students who attend the webinar, and what do you hope to that they can get out of it?
So there's really kind of two things I think I'm going to focus on. Um, the first one is really more about what it is that trading does, for your overall portfolio and your overall growth of your wealth and your net worth, which is really what obviously we want to do here. And I'm going to get into where it fits into an overall portfolio and how to approach that. Um, and then more specifically, when it comes to trading and how to approach markets, I'm going to focus a lot about the things that I like to look at, which is positioning. And how positioning is what I observe to be the real discounting method of a market. And in particular, positioning is where I think you can find some really good risk reward opportunities in the market. A lot of people obviously look at price in a lot of different ways. They look at I tend to be pretty contrarian trader. When people try to be contrarian, they focus on price and say things like, oh, this has gone up a lot, therefore I'm going to short it. I'm against that type of thinking. I think that's how you get run over. I'm not a fighter of the tape, so to speak. So I look at positioning, and within looking at positioning, the COT, commitments of traders data, is one important input of positioning that I use a lot. So I was going to talk a lot about that too and how I use it.
Yeah, perfect. And for people who maybe aren't super familiar with your background, would you mind just kind of touching on that? When you first started trading and your career up to this point.
Yeah, I mean, I'm 56 now. I started trading when I was about 22. When I lived in Asia, I was trading the Hong Kong market. I was trading for myself back then, and did that for quite a number of years. And then I sort of moved on and started managing money, and I worked at a pretty big hedge fund and managed money there for a long time, and then left and started my own firm, my own CTA, which is what I do now. I manage institutional assets in a CTA. I'm a futures trader.
And of course, you were featured in the last Market Wizards book, which I know have been a big influence on you. I know that's a recommended resource to reread those. So just want to mention that as well. And just to emphasize for people who maybe are thinking about attending this webinar, what are some of the top lessons that you hope to pass on to share with them?
Again, trading is to me not about predicting the future. That's what gets you in trouble. Trading is about trying to identify situations where there is good risk reward, meaning if you're going to lose on this trade, you lose $1. And if you're going to make on this trade, you make, $5, $6 type of thing. And over time, That's how you're going to put up positive returns in the market. We all get stuck in this idea of trying to predict the future, which really is impossible to do over time. Doesn't mean any one time you can't say, hey, this thing's going up and it goes up and you're like, oh, I knew it, right? You didn't know it. Okay. It was a heads or tails situation and you got it, right? But over time, I think people will find that that's not going to work for them. What's going to work for them is trying to identify and execute in good risk reward situations.
Yep,
And
perfect.
I'm going to focus on how I find those. I'm not the only one that finds those. I have a certain way that I find them, and I'm going to share that.
Yeah, excellent. Yeah, I'm personally looking forward to learning more about your style from this webinar. So thank you, Jason. Really looking forward to it. To everybody interested in signing up, you can go ahead, as I mentioned, visit traderline.com/university, and there'll be a spot right there where you can register. So hope to see you guys all there, and we'll see you guys in just a bit. Take care. Yeah, thank you very much, Jason. I think that was really good. And even though I'm much more in the trend following camp and you're in the COT data camp, there's some core principles, core pillars that are obviously shared among trading strategies. So I think this is really helpful and provides, like I said, a different perspective on things that's very, very valuable. I definitely have some questions. First, would you be willing to elaborate a little bit more on the news reversal concept? I know you went through it a little bit and shared some examples, but would you be able to just focus on that a little bit because that is, in a sense, your market confirmation when the conditions are right that tells you, all right, this is the time to put on the trade.
Yeah, so like I say, once one of these trades is, let's say, set up according to the COT, I'm really spending a lot of time trying to figure out what people are using to make these decisions, right? Why they're
Right.
so bearish, why they're so bullish. I mean, look, the perfect example was the low in the stock market at the end of 22, was I believe in October of 22. And the market was obviously having a hard time in 22, right? And it was all because this inflation was picking up and people were getting super bearish. Inflation was picking up, rates were going to have to go higher, and that was all going to be very bearish and was. On the day the market bottomed, it was a day of CPI in October of 22. The CPI came out higher than expected. It was the highest CPI print up to that point, and I believe since, but we didn't know that then. Okay.
Yep.
But that day we knew it was the highest CPI number up to that point, higher than was expected. Should have been super bearish the stock market, right? Given what everybody was looking at. And the market went down that day pretty hard and finished higher that day pretty hard. That's the perfect example. This was exactly what bears wanted, right? And meanwhile, the market can't go down on it. What is that telling you, right? To me, it's telling you there's no one left to sell. And if there's no one left to sell, look, take an extreme example. If everybody in the world had every dollar that they had in one trade, that trade could never keep going because there's no money to put into it. I don't care what the fundamental news was. Now, clearly, that particular situation can't happen, but just as an extreme example to make
Yeah.
the point, if every single dollar in the world is long something, how can it possibly go up? There's no more money to go into it, right? So that's kind of what this is about, right? And reading that news can be somewhat difficult. There's some discretion there. And what I find is people, and I have found this in myself too, we see that the stuff is so overcrowded on the COT. So we want there to be a news confirmation thing. And so we read into it. That can be dangerous. I always say it should be obvious. If you have to ask yourself, gee, was that like one of these news failure events? Then it probably wasn't. You know, we have this bias where we want to make something up, to put the trade on, right? Um, so, like I say, if it should be obvious, like that CPI one that day on the stock market was obvious. There was no arguing,
Right.
right? Um, so you have to be just like everything else, super disciplined about not biasing yourself to doing that. And do markets sometimes get super crowded and turn without there being one of these news failures? Yes, they do. And you know what happens when that happens? I miss the trade.
Hmm.
It happens. Do markets get super crowded sometimes and stay that way for a long period of time and the trend just continues, even though it's super crowded, yes, it happens. But because of the market confirmation thing, I don't get killed on those. Well, first of all, because of my risk management thing, even if there were a market confirmation, if it takes out that new low, I get out anyway. And then
Right.
I need a whole nother market confirmation. What is not going to happen is you're not going to have a market fail. Let's say it's going down, bad news, close up on that bad news. Can it go back down through the low again? Sure. But is that going to happen again and again and again and again? No. Usually what's going to happen is you're going to get bad news and it's just going to go down, right? And I'm not going to be in that. So, that's where discipline and risk management come into play, which is more important than all of this. This is
Yep.
one way to trade the markets and one way to be contrarian and one way to pick turns. But no matter what you're doing, as we all know, it's all going to come down to your discipline and your risk management. But what I like about this as well, which helps me a lot, is it gives me defined risk management.
Right.
Here's the bad news day. The market turned. Okay, if it goes back through that low, I'm out. It's not just some random stop number.
Right.
It's a new low. You know what I mean? It's an important point on the chart, right? So it's a point that makes sense from a stop level as well. And then of course, like I'm able to size my positions based on that. I have a defined stop. I have an entry point. I know how much I want to risk each trade. So I'm able to size based off of that too. So that's also part of discipline.
Yeah, and that was actually going to be my next question. How do you determine the sizing of a particular trade? Would you be able to kind of go through an example just with maybe some theoretical numbers?
Yeah, so I mean, I risk a set percentage of my portfolio on each trade. There's no trade to me that looks better than another trade. They all look exactly the same, and I don't have any idea of which ones are going to work and which ones aren't going to work, unfortunately. Okay. Um, but I risk a set percentage, and that's based on where I'm targeting the volatility of my whole portfolio to be, right? I'm trying to target a vol of somewhere around 8 to 9. Um, and so therefore, as I back into it via back testing and via real testing now, I have over 20 years of doing this now, so I don't have to back test, I can real test. But I risk about 70 basis points of my portfolio on a trade. So
Hmm.
I will buy enough so that if I get hit my stop, I lose 70 basis points.
Right.
And the average winner tends to be about 4 to 4.5 times. So, I'll make 3%. I'll lose 70 basis points. I'll make 3%. I'll lose 70. I'll make three. I'll lose 70. I'll make three. And if I can do that, I just need time to tick by, be disciplined to it and let time tick by and I'll put up positive returns.
And that simple sentence that is the key right there, is just turning over that edge as you develop it.
Yes. And the key to that, again, is discipline, right? Sticking to it, not doing other things, not convincing yourself, hey, this trade is going to be the best one ever. So I'm going to put it on, 4 times the size that I usually do. Like we all have those thoughts and we all have those things that we want to do, but you can't. You can't. That's what will turn a winning process into a losing process. Process being the same exact process.
Yeah.
Just your risk management, your discipline falling off will turn that same exact winning process into a losing process.
And having helped a lot of traders now, what are some misconceptions with managing risk and cutting losses and all that you've noticed a lot of newer traders or traders who haven't quite developed their strategy yet, have, and then what do you kind of suggest to them to kind of improve the risk management, improve their process, so they're kind of viewing it the right way.
Just take your loss. You know what I mean? It's like, and a lot of times you'll take your loss and then the market will go back to the way you wanted it to go. And that's depressing. That probably happens 80% of the time, but it's the other 20% of the time that saves you, you know? Like I say, you have to stay alive long enough to get lucky, right? So those will keep you alive. I understand it's frustrating. Oh, I sold it at 50 and, now it's at 60 and now it's at 70 and I missed it and I wish I stayed in. And so then the next time you will stay in and then that'll be the time that'll blow you out, right?
Right.
Everybody loves NVIDIA these days to talk about NVIDIA, but like if you wanted to short NVIDIA at 400, that's fine. You had your reasons you wanted to short it. But when it made a new to an all-time high, just cut your loss. Look what that saved you to this point, you
Right.
know? Um, I actually did a video a few weeks ago where somebody had sent me a portfolio of somebody they had been following, and this person had their buy, their target, their sizing, and their stop. And the portfolio was down like almost 70%, right? Because they didn't take their stops. They were doing things like shorting Nvidia at 300 and their stop was at 500, but they never got out of it. They never got stopped. So they were sitting on all these losing trades. And I ran it and said, what if they had followed their stops? And I'm not even saying that this person was a good trader or a bad trader, or that his stops made sense or didn't make sense. I don't even know. I don't even know who this person is, right? But what I found was if he followed his stops, his loss went from like almost 70% to half of that
Yeah.
just by honoring his stops. And those might have been crappy stops for all I know. I don't know, right? But that would have taken half of his loss away, which means his winning trades would have gone much better towards making him money, right? And this portfolio, by the way, only showed his open trades because apparently what this person does is likes to take a lot of profits, small profits, but then he just rides as losers, right? Which doesn't help. But if he had just done the stops that he had put in, his losses would have been half. And so therefore the ones he was taking winners on maybe would have gotten him to positive for all I know. I don't know. But um that's the point there. Just take them, man. You gotta, you know, I was in this Market Wizards book, and so people, like say, "Oh, he's a market wizard." I'm here to tell you, I'm not, I don't predict markets any better than anybody else. Okay. What if I'm a market wizard? What I feel like I am better at than the vast majority of people is taking losses. I'm really good at taking losses. Okay. I have a defined place where I'm getting stopped. You will never, ever see me. Okay. Not take that stop. You'll see me mess up on some other things. Okay. But you will never see me do that ever. So if I'm some kind of market wizard, it has everything to do with the fact that I take losses better than most people. That's it. I can promise you I don't predict markets any better than anybody else.
I love that. And of course you mentioned that reading Jack's book, first book, was, a really important part of your training early on. What are some key takeaways? Obviously, everybody should go read it for themselves. But what were some of your favorite takeaways that you got from reading that so many times that you think would be really good to be emphasized for all the traders watching this today?
It's the same thing. These guys will consistently talk about risk management, you know.
Mhm.
They will consistently talk about taking losses. Um, this is these lessons just can't be pounded into people's heads enough times. And listen, I read the book and I didn't listen. For the first 10 years of my career, I was just like everybody else. My returns were like a roller coaster, right? I made a bunch of money, I lost a bunch of money, I made a bunch of money, I lost a bunch of money. And 10 years into it, I was getting nowhere. And then I said to myself, maybe I better start doing this, figuring out what the right way to do it is. And I read that book 10 more times and listened and wrote and kept notes and all that. And that really changed what I do. That was able to really make me into a professional money manager and make this my life because of that, you know. So I think those are the important. There's no one in there that's talking about almost no one in there that's talking about how they predict markets.
Yeah.
You don't hear that. You're not getting that. They're talking about their losses. Most of their stories are about their losses and cutting their losses and learning how to cut your losses. I think those are absolutely, it's not the sexiest thing in the world, right? What everybody wants to hear is, well, how do I know if something's going up or down, right? That's the sexy stuff, but it's the most practical thing in the world, and it's the stuff that's going to get you to where you want to be.
So in a sense, that's where the biggest edge is almost over most market participants is cutting your losses and keeping that strict risk management.
I think that's the biggest edge there is. Like I say, I got no edge in predicting the future over anybody, but I think that my edge comes from the fact that part of my edge, a large part of my edge comes from the fact that I don't fool around with losses, man. I take them.
Yeah.
What do they say? The first loss is the best. The quickest loss is the best loss, right? It's okay. You lose. You better get used to it because these people that tell you that they have 90% win rates, I can assure you are lying. There's a scam behind that, if anybody says that, right? Um, because it just ain't true. So you have to be ready to, like I say, over, I have something like 23 and a half years now of this particular process that I've been doing in the same way. 37% of my trades make money.
Yeah.
Okay. But if I can make three, three and a half, four, lose one, make three, three and a half, four, lose one, then I don't need more than 37%. And if God forbid I have years where it's better than 37%, then I have a great year. Last year I think that I did something like 48%. And so I had, sort of an outsized year last year, and that's wonderful. But I'm not going to count on that. Over time, I believe it's going to be 37%.
Yeah. Oh, excellent. And I know you've been doing some podcast interviews with other top traders of different styles as well. I wanted to hear if there were any of those that really stood out to you, some favorite quotes that people may have said to you, or just some of the key topics that came up often during those interviews that, again, you think might be helpful to share here with everybody watching.
Yeah, I very much try when I interview other traders to find people that are doing something other than what I'm doing, right?
Hmm.
Because that's where I'm gonna learn, first of all. And it's where other people can learn. And have people come on and say the same freaking thing that I do, what the hell is that gonna do, right? Um, most of them talk about the same thing. I mean, um, what's his name? Brant. I interviewed Brant and
Peter Brandt, yeah.
Peter Brant, and he's a really good guy and a very experienced guy. And I had asked some of our subscribers if they wanted me to ask any questions of him to give me some questions. And one of the guys was like, "Oh, I read your book, and in your book you were using like this moving average system, and now you say you use this moving average system. Why did you make the change, and what was the point?" And he's like, "Look, it doesn't matter, okay, what moving average you use, okay? It doesn't freaking matter." He's like, "What matters is taking your losses when you're wrong, riding your winners when you're right." And I thought that was just so good because I always say that too. It doesn't really matter what you do, right? Flip a coin, go long if it's heads, go short if it's tails, right? It's the risk management that's going to matter. So I thought that was a great, great thing that he said there. Um, I also think that I'm not a stock person. I'm a futures person. But I did an interview with Oliver Kell, who is he's a momentum guy, and he's kind of like what's an IBD guy? What's his name? The guy that did the Ken Slim method.
O'Neill, yeah.
He's like an O'Neill kind of guy. O'Neill was also in the first Market Wizards. Um, I personally think that that's a great thing. I think O'Neill was great in what he did. I think Ken Slim is great. If you want to be a stock momentum person, I would highly suggest studying that type of stuff. I think it makes perfect sense and has great success rates. I think that clearly because so many people have jumped on it, it has been somewhat, you have to make some adjustments now. I would bet that we're probably prone to more false breakouts in that type of stuff now because so many people are jumping on it, but you can adjust for that, somehow in your risk management, right? Um, and look, that stuff is going to work great when there's a bull market, right? And fortunately, most of the time, there is a bull market, right? So why not be doing something that's going to work most of the time? Now, clearly, you're going to have to watch it during a bear market, um, because that momentum on the long side stuff isn't going to work too well in a bear market. But again, if you're disciplined about it and your stops are in, you know, then if those momentum stocks are getting killed, you're not going to be in them because you're playing momentum. So if you're truly playing momentum, then you're not buying stocks that are getting crushed. You're not saying, "Oh man, this stock went from 100 to 50. I'm going to buy it." No, you're playing momentum. So if you're disciplined about it, you should be okay in bear markets too. But you're probably not going to make a bunch of money, but you won't lose a bunch of money, right? But this stuff, again, the positioning and all that can help with that, right? Again, hey, this is the momentum and I'm in this, but hey, this stuff is saying that people have gotten way too long stocks here, so maybe I got to watch myself, or I'm in these energy stocks and people have gotten way too long energy futures here, so maybe I should watch, this can help with that as well, I think.
Yeah, I think that's excellent. Would you mind kind of walking us through maybe some COT charts, currently, and just kind of talking through how you interpret it, whether, it looks like the speculators are getting too crowded on one side on a particular market. I think might be helpful to kind of bring everything together.
Yeah, so I tried to put in this report the ones that are there right now, which is
Okay.
really the metals and the Canadian dollar, the only ones that are super crowded. It's not like we get 20 super crowded markets at any one time. Um, those are the ones that are super crowded right now.
Hmm.
Um, but what can also be interesting is what's not super crowded, right?
Mm.
Which, truthfully, as much as people want to say that this is some kind of euphoric bull market that's going on right now, from this point of view, from a positioning point of view, it isn't. I can tell you the positioning on the COT with the stock indices is not showing crowded at all.
Mm.
Um, and I get into that like the whole price thing, right? Me as Mr. Contrarian in my old days, I probably would have been shorting this stock market all year because of price.
Right.
But the positioning has kept me from doing that, right? Because it's not crowded. And that's another thing about this positioning thing that can be a big help. Sometimes it's a great predictor, sometimes it's not. But what it is really good at is a risk manager. This
Right.
keeps me out of a lot of trouble. You know, cocoa went up a lot, never got super crowded long, and then it went up a ton, right? I don't know that I necessarily would have made a discretionary trade on cocoa because it's not a market that is my go-to necessarily. But I'll tell you what, the positioning kept me out of shorting cocoa as it went up three, four times, after it doubled and seemed like it was crazy. And then it went up another three times. It kept me from doing all that. So it can help you stay, if you're trying to be contrarian and you're trying to fade things, this can help you to avoid fading the wrong things for the wrong reasons.
100%. And how many trades do you typically make in a year? And obviously, it might be different depending on the year, but on
Yeah,
average.
maybe between 30 and 50, somewhere between 30 and 50. This year was unbelievable slow. I'd
Yeah.
never had a situation like this. In the beginning of this year, basically there were no trades for like
Mm.
3 months, which I've never had in 20 plus years. I've never, ever, ever had that, which again had to test my discipline, right?
Right.
As it turned out, that was wonderful because I didn't lose any money. I mean, if you think about it, my stuff is going to have negative correlation to trend following.
Right.
And the reason my clients allocate money to me, other than, of course, my charming personality and my stunningly good looks, is that they're looking to build a portfolio of negatively correlated return streams with
Right.
positive return expectations. So trend following, as I'm sure you know, crushed it in the beginning of this year. So if I can be zero when trend following crushes it,
That's a
then
win.
I'm doing a great job, right?
Right. Right.
Provided, obviously, when trend following loses, I catch it. Right? I need to get both ends, but usually I will lose a little bit of money when trend following is crushing it, and then I will make a lot of money when trend following is doing poorly, typically. In this particular case, I lost no money while trend following was killing it because I had no trades. Why did I have no trades? Because there was nothing crowded. Why did trend following kill it? And why did trends continue? Because the trends were not crowded. That's how I see it. So, but typically, somewhere between 30 and 50 trades a year.
Perfect. Well, I think, Jason, first of all, this has been really excellent. Like I said, I think this is a great perspective that I think everybody watching can learn from. Are there any kind of closing thoughts that you'd like to leave everybody with today? Words of advice, words of inspiration, whatever you'd like to leave everybody with today.
I just think, we started this webpage a few years ago. I've had a lot of people come through there, okay, and talk about their trading and, this and that and try to help them turn around their trading. So I've been able to witness a lot of people, which I didn't even need to witness because I witnessed myself my whole life and many other traders that I've worked with. But I think that the most important thing that people have to get over is that they are going to predict where the market is going to go better than everybody else over time. You got to get over that. I know it sounds weird. How am I going to make money if I don't predict where the market's going to go? But you got to get over that because it's not good. I've never seen it work for people. Does it work on any individual day, any individual trade for a period of time? Sure. I thought the market was going to go up. I bought it, went up, I made money. I'm a hero. Okay. But over time, that's not what's going to work for you. You're not going to trust me. You're not going to believe me, but I'm promising you, this is coming from 30 plus years of experience and witnessing myself and a lot of other traders. That is not how you're going to make money over time. You're going to make money over time by trying to, you don't have to do it my way, but trying to get yourself into situations that offer much better reward than risk and continually getting into those and realizing, you're counting cards, right? That's what you're doing. That's what a card counter does. They wait, they wait, they wait, they wait, they wait. And when the count gets in their favor, they bet. They don't bet at all because just because the card counts in your favor doesn't mean that it can't come back, right? It can, right? Um, but that's how you do it. You're counting cards. And the advantage you have over card counters is you can't count cards unless you're sitting at the table playing, right? So they play small, they play small, they play small. And then they get the card count. And then when the counts in their favor, they play big. You don't have to do that at all. You can sit here and play nothing and watch and count the cards until the count gets in your favor. And then you can bet, right? So I think that's got to be the most important lesson that I have picked up by observing not only myself, but now observing many hundreds of other people as well. Stop believing you're going to predict the future better than other people. You're just not.
Perfect. Yeah, and I think that's one of my favorite takeaways from today is the edge is in the risk management and like you said, the risk reward managing that. So Jason, again, thank you very much for your time. I really enjoyed this. To everybody watching, I hope you did as well. Leave a like down below. Check out Jason's resources that he shared, and we'll be right back with the next one. So stay tuned. Cheers.
Thanks.